What's going on? I was gonna make a quick video talking about possibly seeing a recession or a market crash, and you're seeing all over the news, CNBC, everywhere, CNN, Fox News. It's the hot topic now that everyone's talking about, and every expert on the planet is going and saying that it's gonna be a recession. It's not gonna be a recession. Jim Cramer saying there's just a big pullback and that it's a great time to be buying. So a lot of people who haven't really studied finance or haven't really been around long enough to know what's happening are wondering or just asking who should they listen to? Should they listen to CNBC? Should they listen to Jim Cramer? Well, there's one really basic concept that the top money managers are following, and it's called the inverted yield curve. And you've even seen David Tepper mention it plenty of times over this bull run, and there's many videos on him on CNBC where they were asking if he'd be worried about some kind of correction or some kind of crash, and he said until the inverted yield curve happens, he's not until the bond market pretty much blows up, then he's not worried about stocks, and so he's been riding that out for a long time now. So basically, you see a bunch of articles now. The Fed's moment of truth on Washington Post. You got a lot of people talking about should the Federal Reserve keep raising short-term interest rates because essentially, if they do, basically, if they keep raising these interest rates, corporations are not going to be borrowing money because it's going to be a lot pricier to borrow money where you could keep expanding on manufacturing and essentially boosting your revenue. And so what happens is when you're constantly borrowing cheap money, also called funny money, as we could call that right now. So when you got corporations borrowing funny money, they could basically invest more into manufacturing, invest more into different, you know, product development, business development, and essentially they will get more revenue, which means that the stock market earning reports are going to come out better and stronger. And it's going to be this big expectation treadmill that you're going to keep seeing. Investors want more of this. They're going to want more earnings, short-term earnings. So these companies keep borrowing. Now, what happens is when the interest rates keep getting higher and higher, so if you keep seeing 50 basis points, 75 basis points being raised, well, what happens is people stop investing, they stop borrowing, and what they do is they know that the stock market is not going to be doing so hot because people are not, it's not going to be synthetic anymore. So what's going to happen is a lot of these companies are actually going to take the money that they're getting and they're going to buy the safest thing out there, which is the treasury notes. So now you see the notes here. You see the 10-year, 5-year, 2-year. So the inverted yield curve, really quickly right now. Obviously, if you're buying a 2-year note, the return is not going to be a lot. It's not going to be as high as a 10-year note. So what happens is when people are essentially going after the 10-year, that means that the demand is going to be a lot higher. And what happens is the return starts going down. And when there's going to be less demand going for the 2-year note, that means that the 10-year note's actually going to go, it's going to be a lot cheaper than it's going to be giving less returns than the 2-year note. And so when the 2-year note is way higher than the 10-year note, that means that as far as return, that means if you just logically think about that, why should I invest in the stock market when a 2-year note is giving me almost the same amount of guaranteed return? So right now, the free risk rate return of the market is about 5% if you have on the stock market, and that's what most corporations are using. Now, if you got the 2-year note, which is about given about 2%, 2.5% return, and if it goes up to 3.5%, even higher, why would I invest into the stock market, which is risky when I have something which is essentially the least riskiest instrument that you could invest into on the entire planet. So why would you not just want to do that 2-year notes? So what happens is a lot of these people, a lot of these corporations and investors just start buying the short-term note, and what happens is less and less people are buying the stock market, which we all know about supply and demand. So whenever there's more supply than demand, then everything just drops. Now, if there's higher demand and less supply, prices go up. So that's basic economics. And so that's what happens with the stock market. So pretty much, if you want to look at more about this information, there's plenty of websites on Investopedia. But basically, in a nutshell, when you have short-term interest rates keep getting higher and higher by the Federal Reserve, less corporations are going to be borrowing money. What they're going to start doing is they're going to put money into these treasuries, right? And what happens is pretty much a lot of the hedge funds, a lot of the big dogs, they know that this is going to happen. So people stop investing altogether in the stock market and they invest into these treasuries instead. And so that's how, when the bond market blows up, stock market follows usually right after. So let's see if there's valuable information we can look at here real quick. So what's an inverted yield curve? Inverted yield curve is an interest rate environment in which long-term debt instruments have a lower yield than short-term instruments of the same credit quality. This type of yield curve is the rarest of the three main curves and is considered to be a predictor of the economic recession. Partial inversion occurs when only some of the short-term treasuries, 5 or 10, have higher yield terms. Inverted yield curve is sometimes referred as a negative yield curve. And then talk about historically, inversions of the yield curve have preceded many of the U.S. recessions due to this historical correlation. The yield curve is often seen as an accurate forecast of turning points of the business cycle. As I was mentioning before, business cycle, how these corporations are going to be investing money into certain areas instead of investing in the stock market, or instead of investing into their own corporations, and therefore their earnings reports are not going to be as strong. So a recent example is when the U.S. Treasury yield curve inverted in 2000, just before the U.S. equity markets collapsed. An inverse yield curve predicts lower interest rates. Yeah, and even going back to 2000 when you had that big tech boom, I mean, you had Yahoo and a lot of these big corporations just borrowing money from anywhere because it was cheap and buying out all these, you know, startup companies that have been around for 5 years and turning them into big billion-dollar payouts for a lot of these founders. And so then you have this big market crash that happens um, because you can't continue creating that synthetic market. But anyways, so it's actually not as complicated when you hear this inverted yield curve. A lot of people, they just kind of, they hear about bonds, they hear about all this short-term stuff, and they really don't understand. But it's really simple, and it's everything's got a little formula, a little cycle. There's always a little cycle involved in these recessions and booms and busts, and then the Federal Reserve obviously plays the biggest part in it. So far, the White House and Trump, they're trying to extend this bull market by doing the tax cuts, and obviously that's going to help out for an extent before the Fed actually comes in and starts putting in their monetary policies. And so, with that being said, we're going to find out. I don't think it's going to happen anytime soon. I think it's going to be a correction. This is just a small intermediate correction. But the overall long term, I mean, we're going to still have to see a lot of these indicators happening. Inverted yield curve, and we'll see. We'll see what happens. It's going to be really fascinating and interesting to see what the Federal Reserve does. But overall, until this happens, you're not gonna really, you can't just go on CNBC and listen to these guys, and everyone's got an opinion and everyone thinks that they're correct. Well, until this happens, then we shouldn't really be worrying too much about an actual collapse. Something like 2007 or 2000 happened. Anyways, hopefully this got you some value. And if you want to see more videos, subscribe, like, and I'm going to be dropping more content, more videos. And have a good day and keep that trading, keep having good profitable returns, and keep pushing for whatever your goals are.